President Joe Biden announced March 31st his plan to release 1 million barrels of oil per day for the next 6 months from the U.S. Strategic Petroleum Reserves. While this plan has not yet been set into action, we should consider the potential impacts of such a historically large release of oil on supply, demand, and price. Ideally, a release of oil this large would help rebalance the market. But with average daily U.S. consumption sitting around 20 million barrels, it would only impact 5% of oil needs in the U.S. The release of 180 million barrels over a 6-month period would also reduce the need for producers to inflate the cost of oil to decrease demand. However, lower gasoline prices in 2022 would support oil demand while potentially slowing production, leaving an even bigger deficit in 2023. Some sources are voicing their concerns about what releasing oil reserves would do to impact the energy market. In an article published by Goldman Sachs, several points were made on the downfalls of releasing reserves. These included potential logistical bottlenecks, particularly on the Gulf Coast, a larger loss of supply, and a growing risk of a recession next year. While we await confirmation of the start of the release of oil reserves, we urge companies to review the impact of higher fueling costs and investigate enhanced, customized, fixed, and variable strategies. These strategies could help alleviate upside price risk and overall volatility. Reach out to a Shipley Energy team member to discuss your options. The team at Shipley Energy is closely monitoring the current world situation and the impacts these actions will have on the energy markets. Stay tuned for more.